Hi, everyone. Mark Lichtenfeld, Chief Income Strategist with the Oxford Club. This is your State of the Market. I've gotten a lot of feedback from viewers who want to know more about options. So today we're going to talk about options. It's going to be kind of a primer for you. And then next week we'll get into some more advanced strategies. Options can be used to generate enormous profits, or they can be used to hedge current positions. So they're a very versatile tool that every investor should at least know how to use. So let's get started. There are two types of options, calls and puts. A call gives the buyer the right, but not the obligation, to buy a stock to call it away from the option seller, and they can do so at a certain price by a certain date. The seller of the call has the obligation to deliver that stock if the buyer demands it. So for example, let's look at Qualcomm. If Qualcomm was trading at $123, a call buyer could buy the November 130 calls for $7. And that means that the buyer of the option has the right, but again, not the obligation, to buy Qualcomm at $130 at any time before the third Friday of November. Options usually expire on the third Friday of the month. $130 is what's known as the strike price, the price at which the stock transaction would take place. Options contracts represent 100 shares. So if you buy one call, you can buy 100 shares of stock. And for that right, you're paying $7 per share, or $700. Now, wait a second. With Qualcomm trading at $123, why would you pay $7 for the right to buy it at $130? Well, if you bought 100 shares of Qualcomm at $123, you would have to pay $12,300. Buying a call contract only costs $700. If the stock goes higher, as you expect, your calls will increase in value, or you could pay $130 for the stock, even though the stock might be trading at $140 or $150 or higher. Most options investors don't exercise their options or make that stock transaction. Rather, they're looking for the call to appreciate in price and profit from trading the call. So if by November Qualcomm was trading at $150, the calls would be worth at least $20 and likely more. So someone who bought the stock would have made $27 or 22%, but a call buyer would have nearly tripled their money. The risk is that the stock does not go up to $130 by expiration. If the stock goes nowhere and is still sitting at $123, someone who had bought the stock still owns it, they're flat, and there's an opportunity that the stock could go higher at some point in the future. A call buyer's option would expire worthless, and they would lose their entire $700. Now, of course, they could sell the option at any time before expiration. You don't have to hold it to expiration. So maybe if they sold it in October, they'd only lose $350 instead of the entire $700. That's up to you as the investor. You can sell it at any time. But it's important to understand that even if the stock rose to exactly $130 at expiration, that call would have no value. Only above $130 would the call have value. Meanwhile, if you bought the stock at $123, you'd have a $7 profit if it's trading at $130. So by purchasing a call, you can participate in a stock's upside with less upfront capital. You can make tremendous gains, but the risk is higher and you can lose all of your capital. So that's calls. Let's now switch to puts. When you buy a call, it's a bet that the stock is going to go higher. A put is a bet that the stock is going to go lower, and it can also be used to hedge an existing stock position. Using Qualcomm as an example again, trading at $123, a put buyer could buy a put, let's say the November $110 puts. That means that at any time by the third Friday in November, the put buyer can put the stock or sell the stock to the put seller for $110. Now, obviously, if the stock is trading above $110, you wouldn't do that. But if the stock is trading below $110, you could force the put seller to buy your stock from you at $110, or the value of the put would increase and you could simply take your profits on the put itself. Now, this is important to understand. You don't have to own a stock to buy a put. You can buy a put purely as a bet that the stock is going to go down. If Qualcomm drops in price, then the put becomes more valuable. Let's say Qualcomm totally blows its third quarter earnings and it's a disaster and the stock drops to $90. Well, if you bought the November $110 puts for $5, if the stock is trading at $90, that put becomes worth at least $20 or a 300% return on your money. Like with the call, you don't have to hold it the entire time. You can sell it anytime you want to before it becomes worthless. So you may still lose on the put, but it doesn't have to be 100% of the value of the put, even if the stock does not trade down to $110. Investors that own the stock can use a put as a hedge, kind of like insurance. So for $500, they can insure themselves and protect themselves from downside worse than, let's say, about 10% if you're buying the $110 puts. They own the stock at $123 and can sell the stock at $110. So in the case of a disaster like the stock falling to $90, the put becomes worth $20. So even though the stock is down $33 because you bought it at $123, when you add the profits from the put, it results in a loss of just $13. Now you can buy puts at your cost basis so that you're guaranteed not to lose any money, but the puts will be more expensive. It's just like insurance. The larger deductible you have, the larger loss you're willing to take, the cheaper your premiums are. The less loss you're willing to take, the more expensive your insurance will be. So buying puts and calls is a great way to make big money without using a lot of capital to invest, as long as you can handle the higher risks that come with trading options. Now, next week, we're going to kind of flip the script a little bit. Next week, we're going to talk about how to generate income with low-risk trades using puts and calls. So I know you're going to want to see that. So be sure to check back next week. And for more income and wealth building ideas, be sure to click the link below for my free e-letter, Wealthy Retirement. I'll see you next week. Thanks for watching.